at the top, you need more capital. And where the lobbying and the intellectual capture has succeeded beyond their wildest imaginations is to have convinced the body politic, possibly at the G20 level, possibly at the Downing Street level, certainly very pernicious at very senior decision-making levels. They've convinced policymakers, pundits, and even practitioners that we have to choose, that society has to choose between safety and growth, that we have to choose between safe banks and shareholder value, and that we have to choose between a safe banking system and a competitive financial marketplace championed by the national host. And each of these have been propagated so effectively that they have influenced and effectively defeated the whole point of reform. So the fact that we have to choose, the notion that we have to choose between safety and growth, you've heard it before, you'll hear it again. If you force us to have more capital, we will have to cut back lending. That will retard the economic recovery, and it will be all your fault. You've all heard that. Do the math. A bank has a €1 trillion balance sheet, funded with 50 billion euros of equity and 950 billion euros of debt. Now come along and the regulator says double your equity to 100 and retire 50 of debt. You've doubled your capital requirement. Has the balance sheet shrunk? No. Have you had to cut back on credit? No. Has society had to choose between safety and growth? No. But the banks have persuaded the body politic that cutting back on credit will be a consequence of safer banks. And if you want to be elected, if you want to do what's right for your electorate and get the economy going, it's a very, very awkward situation to be in. The second one is you have to choose between shareholder value and safer banks. The banks tell me, Bob, you've got it all wrong. If you double capital, you'll reduce profitability of the banks. That will reduce returns to shareholders. Shareholders will have less appetite for bank shares. That will cut off the supply of capital to the banking system, and that will reduce the amount of lending in the system. Well, if you define profitability and shareholder value in terms of return on equity, that might be true. Banks targeted double-digit return on equity. Was that a good measure of profitability? Did that produce sustainable shareholder value? Certainly, less equity with the same return produces a higher return on equity. But as Sheila Bair just announced, the 4 largest banks didn't do very well for their shareholders. Return on equity for long periods of time was very high. But the problem with return on equity is it doesn't adjust for risk. The returns come now, and the related bonuses, but the risks come later, and later came recently. Moreover, investors are getting a little bit smarter. They are interested in risk-adjusted return on equity. Investors buy gilts. They hardly yield anything at all, but they accept the lower yield because of the lower risk. There was a time when Citibank shares were held in every single pension fund in the world because they paid a dependable dividend that seemed to be competitive with the risk that you were taking. The more risk in the balance sheet, the more return the investor will require. The less risk in the balance sheet, the lower the return that the investor will require. Capital will flow in either case, but the cost will be different. The risk-adjusted return will be more or less the same. So banks can have lower ROE with lower risk and produce the same shareholder value with a higher multiple. So you do not have to choose between safety and shareholder value. And the consequence of that is the third one. If your banks are profitable, if your banking system is more stable, why wouldn't your banking system be more competitive? Why wouldn't a highly stable, well-capitalized London be able to compete with an unstable, less capitalized New York? So these are the three myths. They've been wonderfully propagated. They've been swallowed hook, line, and sinker by almost every key decision maker who either believe it or don't want to take the chance that it's wrong. And the result is that we are celebrating steps towards a 3 or 4% leverage ratio when we should be looking at 16 or 20%.